Post Q4 FY24 results, CNBC TV18 did mention that net interest margin of lenders can come under pressure, credit cost will rise and asset quality will also deteriorate owing to normalization. So what has happened? Net interest margin of the lenders continue to remain under pressure for last 2 quarters in a row. Credit cost is rising. Some banks have even raised their FY25 credit cost guidance in this quarter. Pain has continued, especially for lenders having exposure to rural market like microfinance loans, and now even for lenders having exposure to unsecured retail loans. So PSU banks, their net interest income saw decline on a sequential basis for second quarter in a row. Private banks, their NI growth was around 1% on a sequential basis, led by high-yielding retail loans. Tamil Nadu Mercantile Bank, Union Bank of India saw YOY and quarter-on-quarter decline in their net interest income in Q2 FY25. Dhanlaxmi Bank is perhaps the only lender to see YOY decline in its net interest income for third quarter in a row. Now, calculation shows that sequentially net interest margin might have declined by 10 basis points for PSU banks and by about 9 basis points for private banks. So overall, net interest margin has declined sequentially for all the lenders by roughly about 10 basis points. Operating profits grew slower for private banks versus PSU banks. PSU banks' operating profit growth was led by robust treasury gains that they had in Q2 FY25. Overall, operating profits grew by 19.5% YOY and close to 7% sequentially. In this, the operating profits of PSU banks grew by 11% quarter-on-quarter, and that of private banks grew by nearly 2.7% on a sequential basis. Operating profits declined YOY and quarter-on-quarter for lenders like ISAF SFB, Karnataka Bank, IndusInd Bank and Ujjivan Small Finance Bank. 11 out of 39 lenders saw their operating profits decline on a sequential basis. Now, banking sector has reported their highest ever quarterly PAT. So, PSU Bank's PAT growth was robust on account of the fact that they had treasury gains and lower provisioning in this quarter. PAT of private banks was impacted from credit costs or elevated provisioning on unsecured retail loans and MFI loans which slipped into slippages. Overall, banking sector's PAT grew by nearly 3.5% quarter-on-quarter. ISAF SFB is perhaps the only lender to report net loss in Q2 FY25. Now, PAT declined YOY and quarter-on-quarter for lenders like Equitas, IDFC Bank, Utkarsh Small Finance Bank, IndusInd, Ujjivan, RBL as well as Suryodaya Small Finance Bank. 11 lenders saw their earnings decline on a sequential basis. Let's take a look at the asset quality, which has been the best ever for the entire sector. Now, private bank slippages increased substantially when compared to that of PSU banks. Private banks' quarterly slippages increased by 2.7% quarter-on-quarter when compared to a decline of nearly 3.5% for PSU banks. Overall, slippages declined by 0.1% quarter-on-quarter for the entire banking sector. Now, slippage ratio remained healthy or below 1.3% in Q2 FY25. Slippages were elevated for players, especially in the microfinance and unsecured retail credit like ISAF, Utkarsh, Equitas, Suryodaya, etc. Asset quality of the banking sector is the best that you are seeing in last 10 years or even more. And if you take a look quarter-on-quarter, the net NPA ratio or the net NPA has increased for private banks for second quarter in a row. Interestingly, the net NPA ratio difference between PSU banks and private banks is only 11 basis points, which is the lowest ever in last decade or even more. In terms of outlook, let's take a look at what analysts and lenders have to say. While lenders would focus on protecting themselves from increasing credit costs, the loan growth for majority of them may take a backseat. Net interest margin may struggle in the near future. Credit costs seen elevated for some players, especially in the near term. Now, the gap between deposit growth and loan growth will continue to narrow. OPEX will be a key monitor to manage profitability in this tough cycle. Peak profitability is behind and valuation is inexpensive, which means that it is largely priced in. PSU banks have outperformed private banks on certain parameters like operating profits, profit after tax, slippages, as well as asset quality. So in Q2 FY25, laziness got paid off while aggression saw some pain.